The drop in markets since the start of this year has taken tech shares down almost disproportionately against other areas of the market. Why? Was it justified? And perhaps more importantly, what opportunities does it now throw up? Well, we're talking now to Anthony Ginsberg. He's the manager of the Hans Gins Tech Megatrend Equal Weight ETF, which invests in disruptive tech companies. Anthony, welcome.
Hi, great to be with you.
It's a really great sector to educate me as much as anything, because this idea of disruptive technology is relatively new to me. You've just produced your monthly report. I'm going to get onto that in just a minute, but just explain in more detail about what disruptive technologies do.
Yes, by their very nature, they're going to be rather risky. So what we've done is we've got an equally weighted approach across 8 sub-themes. So for us, disruptive technology includes cloud computing, cybersecurity, electric vehicles. It's the broad range of technology, but it's a bit broader than the historic tech, because we include social media, we include robotics and AI, electric vehicles. So that's all part of it. And it's actually a global benchmark. So it's not just the US, it tends to be international. And what we've seen is significant growth, particularly in areas such as cloud technology during the work from home, and the cloud has really benefited from fast tracking during the COVID crisis, as has cybersecurity. And in the US, of course, electric vehicles are now being pushed by the politicians, because by 2035 they're outlawing traditional cars in California, where I am, and across the federal government they're actually big spenders in such things as robotics, AI. There's also another big trend in America, which is the onshoring away from China and the automation of more and more factories and manufacturing in the US. So that's also another one of our themes. And just last but not least, online streaming or digital entertainment, the likes of Netflix. We have all those companies in the portfolio, but we're equally weighted across almost 120 holdings. So it's quite diversified.
Okay, picking up on the point you mentioned about the fact we're in this specialised area of tech companies, do you agree with what I said at the top about the disproportionate drop that we've seen perhaps maybe in tech shares compared to the rest of the markets? If you do agree with that, why has it happened? What is it that's beaten up tech shares more than most?
Yes, well, I'm actually an accountant by training. When I look at what's happened, interest rates, by the very nature that they've almost doubled in the US, it's tarnished with a black brush essentially all growth stocks, of which disruptive tech is a prime example. So our ETF actually doubled in value pre-2022. Obviously, it's taken a beating.
I think we can actually, let's bring up a share price chart, because I think this describes perfectly what you're saying. This rise that we'd had up to the peak that we had there on this chart since, February 2021 was that peak. So you've had this rise, benefited from that, and then comes the plateauing, and then obviously the fall. Yes,
so we've given back quite a bit of the gains. Actually, the PE ratios have already been discounted dramatically, down from the high 20 PEs down to the teens. So we actually see a buying opportunity going forward. Look, the inflation prints, until they start coming down in the US, and the strong dollar is probably going to have a situation where it's going to impact inflation positively in America, because America being so strong with the dollar means they're actually importing cheaper goods now. So I'm hoping that by the first quarter, the Fed will stop these significant rate increases. I mean, it's been one huge range of rate increases the last 3-4 months under Powell.
And it continues.
It continues. So that's not good news for tech stocks. But the truth is, if the prints start coming below 8, 7, 6% levels, the suspicion is also that we have an election coming up in America, and Wall Street-friendly Republican Party members believe they're going to actually take control over part of the Congress in early November. That should actually give a fillip or a boost to the outlook for tech and for growth stocks, because the idea essentially is that they're not as big spenders in terms of boosting inflation numbers. The Republicans tend to be smaller government spending entities.
You mentioned the word weighted. I want to get onto that in just a minute, but very briefly, one other quick question about the general tech picture. How does the fund you concentrate on differ from the NASDAQ? If I was to buy the NASDAQ, would I get the same exposure?
Well, the NASDAQ is dominated actually by those FANG stocks, those 7 to 8 very, very big tech stocks. And actually half the NASDAQ today is almost dominated by essentially 8 stocks. By being equally in weighting. So actually, if you look at the top 10 holdings in the NASDAQ, it's almost about 49% of the NASDAQ. By contrast, our top 10 holdings are just a smidgen over about 13% weighting. So we're essentially about a quarter weighted the way the NASDAQ is. We're equally weighted over 120 stocks. So that essentially means we're about a 1% weighting per stock. Our top 5 is roughly about 7.5%, whereas the top 5 for the NASDAQ again is over 30%. So they've very much dominated and very narrowly concentrated with a handful. We've tried to actually drill down beyond just the mega caps and the big tech to mid caps and even a couple of smaller caps. One thing I should just mention is we have 8 sub-themes across things like cybersecurity and cloud, but they tend to be the leaders in each of those areas. So we have within each sub-theme, it's equally weighted, and they are essentially companies that are all making profits. So if we're actually able to generate a PE ratio for our ETF, that's at the moment around 18, 19 times earnings. By contrast, when the markets were flying, the PE ratios in tech was over 30, so it's been discounted significantly.
But you are equal weight, so that separates out.
So it's a lot more diversified. So we don't have this smothering effect where the top 5, 6 players just dominate the entire portfolio.
Okay, let's drill down then and take a look at where we are and where this market drop has taken us. Where do you see areas, pockets of value, if you like, now within this particular subject that you talk about?
Right. Well, I mean, cloud computing on its own is essentially doubling the size of the market. There's going to be almost $1.3 trillion of new cloud revenues coming on board. What's actually happened during COVID and work from home is that the big regulated entities, this is healthcare companies, hospitals, the big banking sectors, they've all essentially embraced cloud computing. And with people working from home, that means that they've also engineered more cybersecurity usage as well. So cloud and cyber together are actually almost like first cousins. They're basically feeding off one another. The other thing I mentioned was the trend away from China. So as the American manufacturing is onshore because of supply chain problems, there's more and more usage of robotics and automation within American manufacturing. So that's another one of our sub-themes. We're also excited, obviously, about electric vehicles because of the Democratic Party essentially banning traditional petrol cars between 2030 and 2035. So there's just where I am in Los Angeles, there used to only be 1 or 2 charging stations in my building. Today there are almost 20 charging stations in the same building. And the idea of driving your Tesla, let's say, to San Francisco from Los Angeles didn't exist until recently. Now there are infrastructure stations all the way along the coast. So we've seen a dramatic increase in adoption rates within the EV space too.
How flexible is the fund to adopting to new ideas? How often do you undertake a review? Is there much churn within the fund?
That's a very good question. So we actually have a third-party benchmark, an index provider called Selective, and we can actually talk to them about adding an additional sub-theme potentially, but it all goes through a strict index committee, which is really a totally objective, independent committee. At the moment, we have these 8 sub-themes. One of the newer ones that we did add after social media was we added a blockchain sub-theme. No cryptocurrencies per se. It comes back to my more traditional accounting background, which is blockchain being a distributed ledger, more of the back office, the administration side. And that's probably one of the more risky parts of the 8 sub-themes. The others, such as social media or digital entertainment, tend to be fairly well known. Digital entertainment went through a bit of a knock with Netflix, although just in the last couple of days, it's seen a nice uptick. I will just say that online gaming is part of digital entertainment, and it's about 4 times larger than my native Hollywood in LA. So Hollywood, although it gets all the press, gaming now is almost going to be a quarter, well, it's 4 times bigger essentially than Hollywood. So we've seen a lot of usage and acquisitions in the gaming space. Microsoft did the biggest tech deal this year, buying a gaming company called Activision. And even Netflix now, incidentally, have just bought into a gaming firm, as has Google. So there's a lot of growth in the gaming space.
Let's pick up on that point about M&A as well, because when you get an emptying out of the market, let's call it that for sake of another expression, where we've seen this big drop, and it's explained as well by your the price chart of the ETF we're talking about. Do you see opportunities coming in through M&A for companies to buy up other businesses that have been beaten up beyond their below value?
Very much so, because the multiples and the metrics are so much more affordable now. So the risk of overpaying have diminished considerably. So we've looked at the M&A activity. It actually hasn't dropped off. In fact, many expect that there's going to be a lot more M&A because there's some bargains out there, quite frankly. They're picking up metrics that we haven't seen since 2008, 2009, during the great financial crisis. So yes, very much, I believe there'll be more M&A activity, particularly in areas such as cloud computing and cybersecurity, which are growth areas. Increasingly, you're seeing bundling, meaning that cloud outsourcing is being offered with free cybersecurity services, or part of a bundled sort of monthly subscription service. And again, also when it comes to gaming and digital entertainment, those two are increasingly looking at M&A activity. So we expect the likes of Netflix and some of the other gamers to be merging, yes.
I promised at the top of the interview a quick look at your monthly report. What's the message that you're giving at the moment? What's your updated message to investors?
Well, the updated message is that it's very hard to pick on one particular sector. We don't know which sub-theme. We've got these 8 sub-themes. We don't know which one's going to outperform over the next 12 months. So we've taken a more nuanced approach where it's rebalanced every 6 months. And we essentially are taking profits off the table because every 6 months, all 8 sub-themes are back to an equal status. Our view essentially is that the fastest growing fundamentally is cloud and cybersecurity, followed by robotics and electric vehicles. And we think that people should be nibbling already, and it's going to be very hard to, when markets turn, when inflation prints come down, we expect a rebound fairly quickly in the first or second quarter of 2023. So it's hard to time these things. We're saying to our institutional clients in particular, and even some of the retail folks, just to start dipping their toes in the water now, because actually there are a number of bargains out there.
From experience in past downturns, when the upturn happens, is it going to be a vicious rise, do you think, or a slow grind?
I think that when the short sellers are pushed out, it could be quite vicious on the upside. And I think many people are going to miss the first 10 or 15% of the rebound. It's a good question. It's very, very difficult to time it. Our suspicion is that after the American election in a few weeks' time and after inflation prints post-Christmas, we could be in for a nice boost early next year.
One final question. Do you have much cash standing by, or are you fully invested? I mean, I ask the question because opportunities could present themselves when we get that snap.
Yes, it tends to have just a few percentage points in cash. Basically, it is fully invested.
Right.
The most cash we would have is probably about 2 to 3% on the sidelines.
It's a pleasure catching up with you. Thanks indeed. You've educated me deeply into the sector. Thank you so much indeed, Anthony, for joining us. That's Anthony Ginsberg. He's the manager of the Hans Gins Tech Megatrend Equal Weight ETF, which trades under the ticker ITEK, ITEK, which invests in disruptive technology companies. And you can find that fund on the IG platform for ETFs.